It happens faster than most investors think, but you may just have a deal fall into your lap. We go over how to make the financing work for multiple deals at once.
Good.
We're back at the Loan Lounge.
The Loan Lounge. And we're talking about how do you take on more than one property at one time? How you buy more than one property at one time?
Yeah.
Yeah.
I think so a lot of what we talk about are for newer investors, but I kind of think this happens faster than most people think.
Yeah.
Because you get that first deal, you make some money, you get a little bit excited, you get the
fever.
and all of a sudden people are like actively looking.
Yeah.
And I think they land another one and they start the moving parts of it. And then all of a sudden they figure out, oh wait, another deal just came on my plate. And they're like, how do I make this happen?
Yep.
I think it's easier than it sounds. I just always preface like, should you be taking on 2 deals at once?
And I mean, and let's, so how do you take on 2 deals at once? It's easy. Just be rich.
Just be rich.
Be rich.
Simple.
There we go. That's it. Wrap. It's it.
Done.
Oh, so, but what if you're not super rich? Then what do we do?
Yeah. So I think, people's pockets are only so deep.
Sure.
So if you're just buying turnkey properties and putting your standard 20% down, that's probably not going to work for this model to like have multiple deals going on at once and, using your cash strategically. I think you're going to have to kind of consider the BRRRR method of buying, rehabbing, refinance, renting and repeating, because otherwise you're going to run out of cash because you're leaving too much cash in the deal. Yeah,
you're doing a bunch of $150,000 properties. Okay, you're putting $30,000 down plus closing costs and origination. You're probably not out of pocket $40,000, maybe a little less than $40,000, $38,000. But how many chunks of $38,000 do you have?
Exactly.
So I mean, when it comes to BRRRRing, I mean, the big thing that I've been seeing lately, especially with newer investors, is they're not necessarily doing their numbers on the front end.
100%.
And while I don't want to get too deep into MAO or maximum allowable offer, it's a super important thing that definitely, I mean, we'll have another podcast about MAO and maximum allowable offer, but the gist of it is you have your ARV and you want to keep your costs as a certain percentage of your ARV. A good percentage is maybe 70%.
Yeah,
right?
I would say all of our lenders would love that deal.
Yeah, so purchase price plus rehab budget plus any other costs, as long as that's less than 70% of the ARV, that's a pretty decent investment thesis. Like it's not, and ultimately you can make it whatever number you want. It can be 65, it can be 75, although the higher you go, the less meat on the bone in the deal for you. And if you are BRRRRing and you are keeping it, then it's more likely that you're going to have to bring cash to close on the back end when you refinance into a deal.
Yeah. And if you're flipping, that means those margins are getting smaller and smaller and smaller. And your profits are getting small. Your margin for error is getting small. And really, so out of purchase price, rehab cost, and ARV, you only need 2 out of the 3 to be able to figure out what that third one needs to be for the deal to still make sense. So, but yeah, I mean, I think, because alternatively, I always tell clients that like a good deal on a BRRRR is still one where you're leaving 5 to 10% of the after repaired value. I think, sitting around and thinking that you're going to find a perfect BRRRR, it could be a plan, but you better have some patience.
And what's a BRRRR?
Perfect BRRRR would be whatever money that you put down in closing costs on the hard money transaction to take down the property and rehab it. You get 100% of that back as cash out on the refinance into your DSCR loan. I just had one yesterday. Which
a perfect BRRRR?
A perfect BRRRR.
Nice.
So, and again, they happen. I don't want to imply that they don't happen. They just don't happen as often.
How many have you seen this year?
Maybe 3.
Yeah. And we do 100 transactions a month?
Roughly.
Yeah.
So, I mean, like...
Yeah, it's rare.
It's rare. And again, I always tell investors, if that's what you're looking for, let's wait.
Yeah.
But like you're going to be pricing out a decent amount of deals and we're going to be going back and forth with each other. And we're willing to do that with you, but you may only land a deal a year or less. And so it's like, okay, well, what about 5%? And this is for the client to determine. It's not for you or I.
Yeah.
It's for them to figure out, okay, if I have X amount of cash, how much of this could I leave in this transaction? How much could I leave in this transaction? And at what point will I run out of money and then have to kind of figure out, new investment strategies to continue my portfolio growth? There's nothing wrong with it, but it's also for them to figure out. But that 60, you said 38 grand.
Yeah.
on a standard 20% down DSCR loan. Okay, well, let's change that storyline. Let's BRRRR a property. And what you had a purchase price of 150.
Yeah, in that random example that I had, if
so
you're buying for
let's keep it super simple. Let's say we're leaving 10% of the after repair value, or 150 in the deal. I mean, now she just got 2 deals for the price of one
because she's leaving 15,000 in the
you
deal.
leave 15 in it. If
Yeah.
you got it, if you work those numbers a little bit tighter and you're a little bit more strict on the deals that you're taking in, and you leave 5% in the deal, now you're getting 4 deals for the price of one. Now, you, again, will have to be patient. I think I tell investors that all the time. I actually had a guy call me earlier this week, and he's like, can you connect me with more people? Can you do more things? I'm not seeing any deals that are really hitting. And I was like, that's going to happen, where you're just going to be pricing stuff out. I also think you have to kind of play a little bit more hardball, like throw an offer in.
Yeah.
Now, know what you're willing to pay to, get the deal, and don't pay over it. Max available offer.
Yeah.
Little teasers.
Yeah.
But like, put that line in the sand of where you're willing to go up to, and leave the deal if you can't get it to work, because a deal works or it doesn't. It doesn't.
And I mean, at the end of the day, like, okay, if you're sitting and you're watching this and you're sitting in a deal, and let's say your max, you didn't do the math on the front end, and you're like, oh no, I only have X amount of dollars in this deal, and I'm going to keep it as a BRRRR, and it just isn't, it doesn't match up with the math. The good news is that time heals all deals. Like, I mean, there are no bad real estate deals given enough time.
Yeah.
So after time, I mean, I'm dealing with one right now that they didn't have any idea what maximum allowable offer was, and they just had the fever.
Yeah.
And they went and they ran and they went head first into a deal without really crunching the numbers, and and they're a little stressed about it. But what I told them, I said, look, time heals all deals. Like, this is eventually, I mean, it's going to cash flow. You're eventually going to get your cash back out of it. It's going to take 5 years.
Yeah.
But whatever. I mean,
let's see if I can remember all 3 points that I wanted to make on that. One, real estate is not like stock. Stock can eventually be worth nothing.
Yeah.
Real estate will always have a value. I always think that's really prominent. So if market changes, market crashes, any of the other scary things that people talk about all the time, you're still going to have the house. It's still going to be worth something. I mean, hell, even if it burned down, you still have the land. It's still worth something. Second thing, not that I'm saying that your client ran into this, but I think that's a really big factor of making sure you're working with a realtor that specializes in investment real estate. Because if they don't, and they're not doing anything wrong, but they're just finding you properties that make sense, like high level makes sense to, hey, the area tends to get good rents. Okay, that's relative.
Sure.
So I think it's working with a realtor that truly says, yes, I close investment transactions. Maybe even question them about that. How many this year? Tell me about what type of deals those were. Like, kind of put the fire underneath them a little bit to ensure that they've actually done this regularly. Because I think there's a ton of validity there. And then I think the last one's gone.
It went away.
But
that's okay.
Again, I think like there's a couple big factors there that are going to assist to ensure that you get into these transactions soundly. And it came back.
Oh yeah.
So the reason that we say 5 to 10% is because, again, that allows for you to buy, again, 2 houses for the price of one, 4 houses for the price of one. Now, if you go over that, you're 100% right. It's not the end of the world, but we go back to, we had a podcast about like, what is your time worth?
Yeah.
And I think that's what resonates in this conversation for me is, okay, if I'm leaving 15% in the deal, gosh, that's only 5% less of me just buying something turnkey, ready to go, potentially already with a tenant.
Yeah.
And instead I'm going to buy this, go through a hard money transaction, rehab it, then go through a DSCR transaction, and then put a tenant in. Is that worth 5% in equity? Maybe on a $400,000 house, but probably not on something that's like $150,000.
Sure.
So it's just making sure you're not spinning your wheels on something that isn't going to benefit you enough long term. So analyze those deals correctly.
Absolutely.